Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market.
Hello and welcome to this episode of Fixed Interest. I'm Emeric Poisot, Global Head of Investor Development at Fitch Ratings. Today we are looking at inflation, in particular second-round effects after price shocks, which is a key topic for debt investors given its implication for policy rates. I'm joined by our Chief Economist, Brian Coulton, whose team has examined recently post-pandemic inflation shocks and how inflation was transmitted through the economy. Brian, thanks for joining us. Let's start with a very simple question, Brian. What is the big idea in your research report?
Well, look, central banks can't do anything directly about oil prices, but what they've been emphasizing a lot in their commentary this year as the oil price has gone up is that the risk of second round effects. We get a more persistent impact on inflation than just the initial impact on the CPI from the rise in the oil prices. And I think the reason that they focused on that is that this was something that I think they probably got wrong in the period where we came out of the pandemic, when the impact of the supply chain issues, the cost shocks on inflation, it lasted a lot longer. So we've looked at that episode, and what we found that one of the key drivers of that persistence was actually down to corporate profit margin behavior. They resisted the impact of higher costs and squeezing their margins. So not only did they pass on the higher costs to prices, but they added a margin as well. And that led to an increase in domestically generated in inflation. And I think looking back at that episode offers some interesting lessons as to what happened going forward. So if you look at domestically generated inflation, 21, 22, 2023, it really increased a lot. That was reflected in the GDP deflation. It was unit profits that were the key driver of that. And that was because of the fact that firms not only passed on the higher cost, but they added the margin as well.
How different is this period compared to the 70s in terms of transmission of inflation to the economy?
Well, the classic thing that you learn about the risk of second-round effects from oil price and other imported input price shocks is talks about real wage resistance. You know, what happens if you get higher nominal wages as a result? And that was a big deal in the 70s. You know, we had collective bargaining, we had indexation mechanisms, powerful trade unions. Back in the 70s, you didn't really have a strong nominal anchor either, but that was really the story then. That was very much not the story in the post-pandemic episode. It was more about this profit margin resistance, but the mechanism is basically the same thing. It was just that it was corporates resisting any squeeze in their real profits as a result of this import shock rather than wage, but it was kind of price and profit led rather than wage and price led.
So now let's bring what you've identified to today. There's been, as everybody knows, an oil shock. I should say there is an oil shock in the first half of 2026. What's the risk now from the mechanism that you have identified?
Well, when you look back at that, you've got to say there's got to be a significant risk that we get some sort of repeat. You know, firms resist any squeezing of their margin, but some factors look quite different today. There's some reassurance. I think, you know, we had massive fiscal stimulus at the time. Remember, coming out of the pandemic, interest rates were on the floor. Central banks were running very, very loose monetary policies. So those factors should bode well. Also, labour markets are nowhere near as tight as they were. So some grounds for encouragement.
And what is the not so good news?
I think the worrying thing is that if you look at the US, we are starting to see in the last year or so, margins picking up again, the GDP deflator, that measure of domestically generated inflation, that's rising again. I think the risk of second round effects from the oil price shock in the US emanating from firms' price markup behavior looks really quite significant at this point.
Let's now conclude with what it means for, and maybe the biggest question, what it means for central banks and all the stakeholders in the market.
Well, I think for us, it's consistent with our view that the ECB is one and done. The Bank of England is not going to raise rates because labour market conditions are nowhere near as inflationary. And in Europe, unit profit growth since 2023 has really slowed down. So I don't worry too much about this mechanism in Europe. It looks much more significant in the US. And I think it's something that the Fed is going to be looking at pretty closely. And I think it's something that the market needs to pay more attention. This is something that really could force the Fed into feeling that they need to tighten policy.
Thanks, Brian. Research subscribers can access the report titled Price Markup Key to Inflation Persistent on our research platform. That was our chief economist on the transmission of inflation through corporate margins. Thanks for listening.
Subscribe to Fixed Interests wherever you get your podcasts.